Welcome to the Deep Dive, where we shortcut your path to being well-informed.
Oh.
Today, we're diving deep into YM China Holdings. Specifically, their Q3 2025 earnings call, which happened pre-market November 4th.
Right. And our mission today really is to unpack how they're managing this dual-track strategy. You've got rapid expansion on one side.
Yeah, huge expansion.
And then this persistent value focus on the other, all happening in, let's face it, a pretty tricky Chinese macro environment where consumers are, cautious.
So the big question is, can their operational chops actually overcome that consumer headwind?
Exactly. Can the execution win out?
Okay, let's jump right in with the headline numbers. Because honestly, despite all the nervousness about the Chinese consumer, YUMC seemed to deliver a surprisingly clean operational beat on profit.
It did, yeah, which explains the positive market reaction, even though some analysts tag the results as kind of mixed.
Mixed is maybe fair, but the market definitely liked the discipline underneath. So revenue is $3.21 billion.
Correct. Up 4.4% year over year, and that was actually slightly ahead of what consensus expected.
Oh, okay.
But like you said, the real story was the bottom line. Operating profit hit $400 million. That's up 8% year over year.
And a Q3 record for adjusted operating profit, wasn't it?
It was a record. Quite something.
Diluted EPS came in at $0.60, pretty much right on expectations.
Yeah, in line.
Now, the traffic numbers. Same-store sales, SSS, up 1% year over year, and system sales overall up 4%. So, is that 1% SSS good enough? Is it resilience, or is the market just kind of ignoring weak spending?
Well, I think the market reaction tells you something. It suggests 1% SSS is acceptable because of how they got there.
Okay.
Which was, crucially, without tanking their margins. That margin story, which we should definitely dig into, is why the stock popped. They prove they can get people in the door without just, giving everything away.
Right. Let's get into that because it's really interesting. How did they grow margins when costs, especially delivery costs, are going up?
It was a real optimization balancing act. Restaurant margin actually expanded by 30 basis points year over year, landing at 17.3%.
Okay, 30 basis points. How?
Well, two main drivers. First, cost of sales was down 40 basis points. That's mostly supply chain work and maybe some helpful commodity prices. Second, occupancy and other costs dropped a full 100 basis points. They put that down to smarter capex spending, getting more efficient on the builds.
So basically, cheaper chicken and better property deals paid for the higher delivery costs. Is that too simple?
No, that's pretty much it. Those savings were vital because cost of labor jumped 110 basis points.
Wow.
And that was almost entirely driven by higher rider costs for delivery, directly linked to that booming delivery mix.
So it's a trade-off, lower input costs for higher service costs.
Exactly. And they managed to come out ahead by 30 basis points overall on the restaurant margin line. Pretty impressive management.
That focus on managing tiny margins brings us to maybe the standout operational metric they highlighted.
You mean the transaction growth?
Yeah, 11 straight quarters of positive same-store transaction growth.
It's quite a streak. It really implies that core strategy, using value to drive traffic, it's just consistently working, almost regardless of the wider consumer mood.
Consistency is key in quick service.
Absolutely. It underlines their operational strength, their moat. They are definitely capturing that value-conscious spend.
Okay, so speaking of capturing spend, how did the individual brands, KFC and Pizza Hut, contribute to this? Let's start with KFC.
Right, KFC is the engine. SSS grew 2%. They seem to hold prices fairly stable and leaned on, menu innovation, things like those new crackling golden chicken wings doing well promotionally.
And the store growth there is just relentless.
It really is. A record 402 net new KFC stores just in Q3. The pace is accelerating.
But it's not just new stores, is it? There was that K-Coffee thing?
Yes, the K-Coffee Cafe module. It's a really smart synergy play. It's now in 1,800 locations, way more than expected.
Performance.
Daily cups sold per store were up 30% year over year in Q3. Things like their sparkling Americano series really hitting the mark.
Hold on, 30% growth in coffee cups per store. That's significant.
It is. It suggests they're really effectively using existing space, existing staff, to grab that sort of light meal, snack, and beverage market.
Without huge new capital costs, it's like capital light day part expansion.
That's a perfect way to put it. Finding growth inside the existing box, basically, making each location work harder.
Okay, now Pizza Hut. Because this story is maybe even more dramatic strategically, SSS also grew 1%, like KFC.
That hides the really startling number. Same-store transaction growth was up 17%.
17 for the third quarter in a row, right?
Third straight quarter. Massive traffic pull. But, and it's a big but, the average check, the ticket price, was down 13% year over year.
Whoa. Okay, so that confirms the strategy, doesn't it? They're deliberately going after the mass market.
Absolutely confirms it. That 13% drop isn't an accident. It's a conscious pivot. Lower priced pizzas, more affordable combos, trying to drive sheer volume.
Is that sustainable, though? I mean, dropping prices that much. Are you risking cheapening the brand long term? Maybe hurting the full-service dine-in side?
That's the million-dollar question, isn't it? Management argues they're gaining share, getting new customers in the door. They pointed to that new handcrafted thin-crust pizza.
Uh-huh.
It's cheaper to make, cheaper to sell, and apparently it quickly became the best seller, like 1 out of every 3 pizzas sold now.
So they're trading margin per customer for customer volume and presumably market share.
That seems to be the bet. If the consumer stays cautious and focused on value, Pizza Hut is positioning itself as the go-to affordable option in its space. It's defense playing offense.
And they also crossed a store milestone there too, didn't they?
They did. Pizza Hut passed 4,000 stores this quarter. Yeah. So there's physical momentum alongside that strategic shift.
And all that transaction volume must be linked back to delivery, right? That huge delivery mix you mentioned?
Directly. Delivery mix hit 51% of total sales. Last year was 40%.
51%.
Yeah. So while it dries up those rider costs we talked about, it's also the engine delivering those huge transaction gains, especially at Pizza Hut. Convenience is king.
Could management say anything about the delivery aggregators? You know, the platforms and the promotions and costs associated with them? That's a headache everywhere.
They acknowledged it, yeah. So the increased promotions and subsidies from aggregators are definitely a factor impacting cost right now, sort of a near-term thing.
But their approach?
Their stated position is disciplined. They want to protect their own margins, their brand. No. They seem to be betting that the heavy subsidy environment won't last forever and aren't just chasing every cheap deal recklessly.
Okay, let's shift to the future. Strategy, guidance, the expansion plans are just incredibly aggressive.
They really are. 536 net new stores across both brands in Q3 alone. That brings the year-to-date total over 1,100.
1,119, yeah. It feels almost like breakneck speed, especially given the consumer mood.
It is fast, but it signals huge confidence from management in their model, particularly those localized unit economics. They confirm they're still on track for 1,600 to 1,800 net new stores for the full year 2025.
And the long-term target?
Still aiming for 20,000 stores by the end of 2026. That's roughly 10% unit growth per year, right. Macro noise or not.
That scale is mind-boggling, but the key has to be the efficiency of that build-out, right? If sales per store are maybe a bit pressured, the cost to build better be low.
And it is. That's a crucial financial point they stressed. Per store capex, the cost to build a new store keeps coming down.
How much?
For KFC, it's down to around 1.3 to 1.4 million RMB. For Pizza Hut, it's even lower, like 1.0 to 1.1 million RMB.
So building cheaper means they hit profitability faster on each new unit.
Exactly. Even if initial sales are a bit softer, it's an internal buffer they've built through efficiency. The overall capex target for the year remains $600 to $700 million.
So optimizing existing kitchens and optimizing the cost of building new ones, that's quite a combo.
It is.
And speaking of defense, they also doubled down on shareholder returns, which always sends a strong signal in a shaky market.
Absolutely. They're on track to return $1.5 billion to shareholders in 2025. They've already done $950 million year to date through dividends and buybacks.
And the quarterly dividend is $0.24.
Yep. And this is all backed by a really strong balance sheet. They're sitting on about $2.7 billion in net cash.
So that level of return, what is that, like 8 or 9% of their current market cap annually?
Roughly, yeah. It basically screams management thinks the stock is cheap, and they have absolutely no worries about funding that huge expansion pipeline.
Okay, let's circle back to synergy. Because managing 20,000 stores efficiently, it can't just be about KFC and Pizza Hut as silos. They talked about smaller formats too.
Right, using specialized formats for efficiency and also market penetration. They highlighted 2 key ones. First, K-Pro.
The light meal concept.
Yeah, energy bowls, smoothies, that kind of thing. It's expanded to 100 locations now. The key is it leverages existing KFC infrastructure, kitchens, logistics, and crucially, the huge KFC membership program. It's mainly targeting higher tier cities for now.
And that's different from the Pizza Hut approach for smaller cities.
Totally different. Pizza Hut Wow is the other side of the coin. It's a low capex model, much cheaper to set up. It's hit 250 stores.
And its purpose?
Penetration into new lower-tier cities. They said it's allowed them to enter 40 new cities where they had zero presence before. It's designed for places where demand for affordable pizza is high, but maybe real estate costs are lower.
So they're segmenting everything. Food type, store format, city tier, capital investment.
Very sophisticated segmentation strategy.
Looking ahead, Q4 guidance, it's usually the low season, right? What did they signal?
They guided for system sales growth in the mid-single digits and same-store sales growth similar to Q3, so around that 1% mark. They were pretty clear that the high delivery mix means those rider costs remain a headwind. So continued focus on operational efficiency is absolutely necessary to offset that.
We should probably also quickly mention the parent company situation. YUM Brands is reviewing Pizza Hut globally?
Yes, management confirmed they know about that review, but they strongly reiterated that they are an independent company focused only on China.
Right.
And they believe the Pizza Hut brand in China is strong and has great growth potential, regardless of what happens with the global brand structure. That's a key distinction for investors.
Okay, so let's try to tie this together for investors, because here's that weird divergence we mentioned earlier. You have this picture of, frankly, pretty flawless operational execution, strong balance sheet. And yet YOMC stock has really underperformed the broader China benchmarks like the MSCI China or KWEB ETFs over the last few months and even the past year.
It's that classic conflict. Localized company strength versus systemic market fear.
Yeah, the company seems to be executing its strategy perfectly. Grow the footprint fast, defend value, drive transactions through efficiency. But the stock price seems stuck because of generalized China macro fears.
That macro anxiety is the wall they keep hitting. Logically, confirming the growth targets and the margin stability should support a higher valuation. But the market seems to be waiting for something more.
Which leads us straight to the big catalyst coming up. The Investor Day on November 17th.
That's going to be critical. They're expected to share their new 3-year growth algorithm. The market desperately wants to see if that aggressive expansion translates into an accelerated system sales forecast, something better than what's currently baked in.
Right. Is the growth story about to inflect higher? That's what the bulls need to hear.
Okay, speaking of what might happen, now's the time for our regular segment. This is not financial advice.
Definitely not financial advice.
But if you had to pitch a trade idea based purely on this earnings call and situation, what's the aggressive but plausible concept?
For me, it has to revolve around that huge capital return commitment, that $1.5 billion.
Exactly. That's the anchor. The thesis is this company has a proven operational moat look at those 11 quarters of transaction growth. And they're committed to giving back 8-9% of their market cap annually through buybacks and dividends. That cash return provides a really strong, localized buffer against the general China consumer risk that's dragging everything down.
So the aggressive pitch is?
You go long YM China. You're betting specifically on their execution, their unit economics, their cash returns winning out over sentiment.
Okay.
But to hedge that systemic China risk, you can't control the macro. The geopolitics, you pair the long YUMC position with a short or maybe deep out of the money put options on a broader, more sentiment-driven China ETF, something like KWA.
Interesting. So bet on the company's specific strengths, hedge the country's general weaknesses. Betting management execution beats market fear.
That's the essence of the trade idea, yeah. Based on the data presented.
Okay, let's recap the whole deep dive then. 2 main takeaways from this Q3 call, I think. First, impressive resilience through operational efficiency. They expanded margins even with soaring delivery costs.
Right. And second, the sheer commitment to accelerated growth. Unit expansion is running ahead of schedule, and those new formats like K-Coffee and Pizza Hut seem to be integrating successfully and adding diversification.
So for you listening, what's the bottom line? The Chinese consumer is definitely cautious, focused on value. YUMC seems to be navigating that extremely well, capturing transactions via smart pricing and efficiency.
But the whole story really hangs on that Investor Day, November 17th. That's the pivot point. Will the new 3-year plan show an acceleration in growth that justifies a higher stock price?
Or will it just confirm stable, solid execution in a tough market, which might not be enough to break free from the broader China discount? That's what everyone will be watching.
It's the key data point for the next couple of weeks, absolutely.
A critical event. And please remember, as always, none of this constitutes financial advice. We're just analyzing the information presented.
Thanks for joining us for this deep dive. Catch you next time.